Welcome to the Deep Dive, your shortcut to being well-informed. We cut through the piles of reports, the articles, the expert notes, all that noise, and pull out the really important bits, the nuggets of knowledge, just for you.
Get you up to speed quickly.
Exactly. And today, we're starting with something that honestly might make you do a double take.
Go on.
Volkswagen's electric ID.3 hatchback. Nice car. In Germany, you're looking at maybe $35,000, roughly, after rebates.
Okay. Standard EV price range for Europe, more or less.
Right. But in China, less than half that.
Wow.
For pretty much the exact same car. How on earth is that even possible?
It's a stark comparison, isn't it? And that huge price gap, it's not just some fluke.
No.
No, it's a massive signal. It basically tells you almost everything you need to know about the sheer intensity of the competitive environment in China right now. It points right to the heart of the shift we're diving into today.
Okay, so let's dive in. Today, we're looking at this huge transformation that's shaking up the global car industry. We're going to try and unravel this story of why the big car companies are losing China, specifically in this booming market for new energy vehicles or NEVs.
Yeah, it's a massive story.
Our mission, as always, is pretty clear. We've got this stack of recent reports, sales data, expert analysis, all the stuff you provided, fresh from, like, August 2025.
Right, the latest numbers.
And we're going to extract the critical insights, the stuff you really need to grasp this incredibly fast-moving landscape. We want to give you the surprising facts, maybe a bit of perspective, and hopefully keep you hooked along the way.
And just to be clear, this isn't guesswork or opinion. We're basing this deep dive on, solid current data.
Right.
We're pulling from the industry authorities, CPCA, CNEV Post, Gasgoo, Automobility, and we're even looking at the latest financial results straight from the big players themselves, like BYD, like Volkswagen Group.
So real numbers, real trends.
Exactly. Hard data, verifiable trends. Nothing fuzzy.
And this matters, right? Whether you're actually in the auto industry or maybe you're a tech enthusiast just watching where things are going.
Or an investor, maybe.
Or an investor trying to figure out these market shifts. Or honestly, even if you're just curious about how these big global power dynamics play out in everyday products, understanding this shift is, well, it's crucial.
Absolutely critical. What's happening in China's car market isn't just about cars.
No.
It's really a blueprint. It shows you how fast markets can change, how fierce competition can get. The implications go way beyond just the auto sector.
It's a fascinating story, and we're going to try and make it crystal clear for you. Okay, let's set the scene. Where are we right now? Because China isn't just a car market. It is, hands down, the biggest in the world.
By far.
And maybe the most competitive, just cutthroat.
Yeah, absolutely hyper-competitive.
But something really deep, something fundamental has changed there. The old way of doing things, the old leaders, that's all getting turned upside down, isn't it?
It really is.
Yeah.
And to, fully appreciate just how big this change is, you kind of need to look back a bit.
Okay.
Historically, foreign brands, especially the big European and Japanese names like Volkswagen, they basically ruled the roost in China.
Dominated.
For decades, yeah.
Yeah.
They almost had a monopoly, setting the terms. Volkswagen famously was one of the very first foreign car companies back in 1978.
Right, the pioneers.
And they did incredibly well. By the early 2000s, VW held something like 50%, half the entire passenger car market. Cars like the Santana weren't just popular, they were everywhere.
Icons, almost.
Absolutely. Synonymous with driving in China, with aspiration. For these global companies, it was a golden era. Highly profitable, less intense competition. And they called the shots.
Okay, so that was then. Fast forward to now, mid-2025. That picture looks totally different.
Almost unrecognizable, yeah.
We're seeing this huge change. New energy vehicles, NEVs, they've hit this tipping point. They're not niche anymore. Not just for early adopters or because of subsidies.
No, they are the mainstream now.
Yeah?
Definitely.
The numbers are just, staggering. In July 2025, the retail penetration rate for NEVs, 54.7%.
Over half.
Over half the cars sold. And year to date, it's 50.81%. Just think about that. More than half the market is now electrified. It's not a trend. It's just the new reality.
It really is. And, for the first half of 2025, looking at those numbers, NEVs actually outsold traditional gasoline cars for the first time ever.
Wow, okay. What were the numbers?
It was about 5.47 million NEVs compared to 5.43 million gasoline cars. So it's official. the crossover has happened.
That's huge. And it's probably worth clarifying quickly what NEV actually means in China, because it's not just pure electric, is it?
That's a really important point, actually. No, it's broader. NEV includes pure battery electric vehicles, the BEVs everyone thinks of.
Like Teslas.
Right. But it also includes plug-in hybrid electric vehicles, PHEVs. Those combine battery power with a small gasoline engine for range.
Which are really popular there, too.
Hugely popular.
Yeah.
And technically, it also includes fuel cell vehicles, FCVs, but they're still a tiny, tiny fraction of the market. Okay.
But understanding this broad definition, especially the inclusion of PHEVs, is crucial. It helps explain how the local Chinese brands have been so successful. They're using both pure electric and hybrid strategically to grab different types of customers.
So covering all bases.
Exactly. Urban buyers might go for a BEV, but someone needing longer range or living where charging isn't as easy might prefer a PHEV. It's an all-of-the-above electrification strategy, and it's working incredibly well for the domestic companies.
It makes sense. And to give people a feel for just how fast and complete this change is, I keep thinking of analogies. Like, remember landlines?
Oh, yeah. Ancient history now.
Right. For ages, everyone had one. The big phone companies were untouchable. Then, boom, smartphones took over. And those old companies were just scrambling, weren't they? Many didn't make it.
It's a good parallel. The underlying tech just shifted completely.
Or, okay, another one. Imagine your favorite restaurant. Maybe it always served amazing, classic Italian food. You go there for years.
Your go-to spot. Then, seemingly overnight, you walk in, and half the menu is suddenly this super modern, fancy nouvelle cuisine.
Right. Totally different style.
The customer's taste just radically changed. And if you're the chef still just making lasagna, even if it's the best lasagna ever, you're going to struggle. The market basically rewrote the menu.
That's a great way to put it. The expectations have fundamentally changed. And this shift has totally upended who's leading the market.
So who is leading now?
Well, in the first half of 2025, the Chinese brands aren't just participating. They are absolutely driving this growth. They captured a massive 68.5% of the total passenger vehicle market.
68.5%. What was it just a few years ago?
Back in 2020, it was only 36%.
Wow, that's an incredible jump in just 5 years.
It's monumental. And here's the kicker from the data we analyzed. Essentially, all the year-over-year growth in the entire Chinese car market came from the local Chinese OEMs.
All of it.
All of it. The foreign brands overall were flat or declining. So it's not just a trend, it's like a complete handover of momentum. The growth engine is now firmly domestic.
Okay, that's a clear picture of the shift. But it makes you wonder, doesn't it? This explosive growth, over 50% EV penetration, how sustainable is that rate? Especially with the government now stepping in to cool down these crazy price wars we've been seeing.
That's the big question right now. It's a genuine knowledge gap.
Right.
Are we seeing the market kind of find its natural level, maybe mature a bit after this incredible surge? Or is this intervention just a temporary brake pedal and the aggressive expansion will pick right back up again once things stabilize?
Something we, and you listening, definitely need to keep an eye on through the rest of this year. Okay, so let's get into the specifics. This is where it gets really, really interesting because the numbers tell such a clear story of, well, winners and losers.
Contrasting fortunes, definitely.
You can really see who's riding this wave and who's getting kind of swamped by it.
Absolutely. On one side, you've got just the phenomenal rise of the Chinese champions. It's almost hard to believe sometimes.
Like BYD, right? They seem to be everywhere.
Undisputed leaders. Let's look at July 2025 numbers. BYD sold retail 274,644 passenger NEVs.
Just in 1 month.
Just in July. That gave them a 27.8% market share. Almost 28%. Now, that specific number was actually down a little bit from June and down from July last year.
Okay, a slight dip.
Yeah, slight dip month over month, year over year for July itself. But context is key. They are still miles ahead of everyone else in terms of sheer volume.
Right. And the year-to-date picture?
Even stronger. January to July 2025, BYD sold 1,884,686 NEVs. That's nearly 1.9 million.
Wow.
Giving them a 29.2% market share for the year so far. That's not just big, it's like an entrenched leadership position. They are the benchmark right now.
And it's not just about selling cars anymore for them, is it? They seem to be becoming this, like, global powerhouse.
Oh, completely. Their financials are, well, pretty staggering, too. First half of 2025, revenue surged, what was it, 23.3%?
Yeah.
To 371.3 billion yuan.
Huge numbers.
And the really key part, their auto division cars and related stuff leaped 32.5%. That's now like over 81% of their total sales.
So they've really doubled down on cars. It's not just one part of their business anymore.
Exactly. There used to be more diversified batteries, electronics, but this shows a clear, deliberate, and obviously successful pivot. They are laser-focused on automotive now, which is maybe different from some legacy players still juggling priorities.
And they're looking outwards too, right? Global ambitions.
Massively. Overseas sales in that first half skyrocketed 130% to 135 billion yuan.
130%.
Yeah, I know. They're pushing hard globally, setting up a European HQ in Hungary, breaking ground on a factory in Cambodia. They even operate their own fleet of cargo ships now to get the cars delivered worldwide.
Their own ships. That's serious vertical integration.
It's integrated, it's aggressive, it's very strategic. They're leveraging that dominance at home to fuel this global push.
And what about innovation? Are they just making cheap EVs, or is there real tech there?
Oh, the R&D spending tells a story. In the first half of 2025, they pumped 30.88 billion yuan into research and development.
30 billion?
Yeah, which is up a massive 53% from the year before. And get this, that R&D spend is way higher than their net profit.
So they're reinvesting heavily.
Hugely. It screams long-term strategy, building capability, prioritizing tech leadership over just maximizing profit right now. You know, globally, by July, BYD had sold almost 2.5 million vehicles this year in total.
Wow.
And overseas deliveries were over 550,000. That's already more than they sold overseas in all of 2024.
So that 130% growth is real.
Absolutely. It's not just catching up. They're setting a new pace.
Okay, BYD is clearly the giant. But are other Chinese companies doing well too?
Definitely. It's not a one-horse race. Look at Geely. Another established Chinese player owns Volvo, Lotus.
Right, big group.
Their NEV growth is also explosive. In July, they sold 121,385 NEVs. That's a solid 12.3% market share. And the growth, 112% year on year.
Doubled their sales from last July.
Pretty much. And year to date, they're at over 800,000 NEVs, 12.5% share, with growth of 122%. So yeah, Geely is surging too.
So the established Chinese players are strong. What about newcomers? We hear a lot about tech companies getting into cars.
Yeah, the new guard is absolutely shaking things up. HEMA, that's the brand backed by Huawei technology.
Okay.
They delivered over 47,000 units in July, almost 5% share already. Shows the power of that tech integration.
Leap motor.
Also strong. Over 45,000 units in July, 4.6% share, and up 106% year on year.
And XPeng, known for their software, right?
Exactly. They had a phenomenal July. Sales up 263% year on year. Sold nearly 34,000 cars.
263%.
Crazy numbers. Shows how quickly these focused players can ramp up when they hit the right note with product and tech.
And we have to mention Xiaomi, the phone company, right?
Wow.
Their entry has been, well, dramatic.
Understatement. Xiaomi EV delivered over 30,000 cars in July, their first July selling cars.
And they only launched, what, 15 months ago?
Something like that. It's an incredible ramp up. Remember their YU7 SUV launch?
Yeah.
Orders. 200,000 firm orders in 3 minutes.
3 minutes. It's unbelievable.
It just shows the power of a trusted tech brand leveraging its ecosystem, its marketing muscle, its speed. They're not just making cars, they're selling connected devices on wheels, and it resonates massively.
Okay, so that's the Chinese side, explosive growth, tech disruption. What about the other side, the foreign giants? How are they faring in this new NEV world?
Well, it's a much, much tougher story. In stark contrast, actually. Many are losing traction, especially in NEVs.
Like Tesla, they were the EV pioneers.
They were, globally. But in China, their share is sliding. July 2025, they sold about 40,600 cars retail. That's only a 4.1% market share. And that's down from 5.5% just the month before, in June, and down from 5.3% a year ago in July 2024.
So they're losing ground relatively quickly.
Yeah, it caused them to drop from 4th place in NEV sales down to 8th place just in that 1 month.
Ouch. And year to date?
Year to date, January to July, Tesla sold about 304,000 cars. That's a 4.7% share, ranking them 5th overall in NEVs. But significantly, their sales are actually down 6.3% compared to the same period last year.
So in a booming NEV market, Tesla's sales in China are shrinking.
Exactly, which is very telling. And another thing, their exports from China, the made-in-China cars they ship globally, those plunged 32% in the first half of 2025.
32%. Why would that be?
Could be several factors.
Yeah.
Weaker demand in export markets, maybe shifting production priorities, more competition everywhere. But it definitely indicates some broader challenges for them.
Okay, so Tesla's struggling. What about the real legacy giant, Volkswagen? Once the king of China.
Yeah, VW's situation is Particularly stark when you look at EVs. Globally, the VW Group is actually doing okay with electric cars. Their worldwide BEV deliveries were up 47% in the first half of 2025.
Okay, that sounds good.
But in China, their BEV deliveries declined massively by 34.5%.
Declined by over a third, while the market is booming.
Precisely. They went from selling about 90,600 BEVs in H1 2024 down to just 59,400 in H1 2025.
That's bad.
It's really bad. And their overall sales in China, including gasoline cars, were down 2.3% in the first half. Their total market share has slipped significantly too, from around 15% historically down closer to 11% last year.
And the ID.3 we mentioned, the one they're selling cheap.
Yeah, even with that aggressive price, less than half the German price, it's struggling. Reports consistently mention buggy software.
Right.
And crucially, you still have to take it to the dealer for software updates in 2025.
Well, the Chinese brands are doing over-the-air updates constantly.
Oh, exactly. It's a huge mismatch in user experience expectations.
Yeah.
It's not just a small bug. It feels fundamentally outdated in that market.
Okay, so European brands are struggling. What about the Japanese? They're known for reliability.
They're struggling too, especially with the shift to electric. Honda, for example, combined their two joint ventures, Dongfeng Honda and GAC Honda. Their total sales in July 2025 were just over 40,000 units, down 13.4% from the year before. But here's the really shocking number. Honda's production in China in July, down 76.9% year-on-year.
77% drop in production.
Yeah, that suggests they're facing major issues, not just selling the cars they have, but maybe adjusting production lines, dealing with inventory. It points to deep structural problems adapting.
So it's a pretty bleak picture for most foreign brands right now.
It is, especially in the NEV space.
That analogy you used earlier, the tech company that invented the smartphone but got stuck on an old OS.
Yeah.
That feels like Tesla in China now, maybe. They had that default BEV advantage, but the local guys innovated so fast on software and features, Tesla seems to be losing that edge there.
That's a fair comparison in terms of the pace of software innovation.
Yeah.
And for the other foreign brands tied to those older, slower ways of doing things,
Right.
it really is like bringing in a 90s F1 car to race against modern electric hypercars.
The tech is just different.
The tech, the speed, the whole approach, the game's changed, and the old playbook just doesn't work anymore.
Which leads to another one of those knowledge gap questions, doesn't it? For Tesla specifically, how much of their sliding market share is purely because the local competition is just that good now?
Right.
Versus other things, like are consumer tastes changing away from Tesla specifically? Are there supply chain issues we don't see? Or maybe even geopolitical factors playing a role?
It's almost certainly a mix of things.
Yeah.
Disentangling those threads, competition, consumer preference, supply chains, maybe even brand perception is really complex. But the competitive pressure is undeniable. So what's driving this, what's fascinating, and what we're calling China's new rulebook, is how these Chinese companies have just fundamentally changed the game.
Rewritten the rules.
Completely. They've created a whole new way of operating, a set of principles that's totally different from the global standards the foreign brands grew up with. It's not just about making EVs. It's a whole new philosophy of car making, marketing, and selling.
Okay, so what's rule number 1 in this new book?
Speed. Speed is a weapon. Everyone talks about China speed. Chinese OEMs work on incredibly compressed development cycles. They refresh models constantly. Not just every few years, sometimes every few months, they're pushing out new trims, new features.
And software updates, right? OTA.
Critically, OTA updates. Over-the-air software updates, like your phone gets. They push these out sometimes weekly, adding features, fixing bugs, at a pace that traditional legacy auto processes just physically cannot match.
So a foreign car might launch, and it's already feeling old compared to a local rival that's had 3 updates since.
Exactly. Think about Xiaomi again, that YU7 SUV. They launched it, got those 200,000 orders in minutes,
Yeah.
and started deliveries almost immediately. They sold 30,000 cars in July, just 15 months after even entering the market. Compare that to the typical multi-year design freeze, validation, launch cycle for a global model.
It's a different galaxy of speed.
It's a fundamental, almost structural disadvantage in agility for the incumbents.
Okay, speed is rule 1. What's next?
Rule 2 is deep vertical integration. This is huge for cost, control, and resilience.
Controlling a supply chain.
Way beyond just controlling it. China, strategically, has immense control over the battery supply chain think giants like CATL. Local car companies can integrate the battery cells, the packs, the electric motors, the power electronics, often in-house or through very tight local partnerships.
Which does what for them?
Cuts costs significantly, shortens lead times dramatically, and it gives them a massive advantage when price wars break out, which they constantly do.
Because they control the most expensive parts?
Exactly. Foreign brands, often relying on imported batteries or components, dealing with global logistics, tariffs, currency swings. They're just boxed in. They don't have the same cost levers to pull.
Makes sense.
Yeah.
Like that analogy you use, controlling the recipe and all the ingredients versus having to import everything.
Precisely. That cost and resilience advantage from vertical integration. It's a total game changer in this market.
Okay, Steed, vertical integration. What else is in this new rulebook?
The third big one, software-first cars. The digital experience is king.
This seems critical in China.
Absolutely non-negotiable. For Chinese buyers in 2025, the car isn't just transport, it's like another smart device, an extension of their digital life.
So they expect.
They expect really advanced in-car systems, sophisticated voice assistants that actually understand local dialects and commands naturally, big responsive screens, app stores full of local services, maps, music, payments, social media integration like WeChat.
And driver assistance, ADAs.
Oh yeah, advanced AD is table stakes, intelligent cruise control that works well in dense traffic, automated parking that actually works, comprehensive lane keeping and traffic jam assist, and seamless smartphone integration, obviously.
So companies like Xiaomi are leaning into this, treating the car like a phone on wheels.
Pretty much. They talk about it as a digital terminal within a broader network of connected devices. It's about the ecosystem.
And the foreign cars.
Often arrive feeling underspec'd on the software front. They might have the hardware, but the user interface feels clunky, the voice assistant isn't great, the apps aren't there. It feels dated immediately.
Like the VW ID.3 needing dealer visits for updates.
That's the most extreme example, but even others. Mercedes, Toyota, they've had embarrassing software recalls in China. It highlights a fundamental gap in capability, or maybe just priority. It's like, yeah, trying to sell that powerful desktop computer to someone who just wants a sleek tablet experience with constant, seamless updates. The whole expectation is different.
Okay, rule 4. Is there more?
Yeah, new ways of selling, new go-to-market channels.
Not just dealerships.
Less and less just traditional dealerships. Think live stream sales events, hugely popular. Direct online ordering. Pop-up stores and flashy malls, often with what they call brutally transparent pricing.
Meaning no haggling.
Often, yeah. Fixed price, take it or leave it. This transparency and direct engagement bypasses the slower feedback loops of traditional dealer networks. The local brands get instant market reads, react faster. Foreign players are often still relying on dealers telling what's happening, which is just too slow.
Sweet again.
It all comes back to speed and agility, really.
So this intense competition, this China speed, these price wars.
Yeah.
It sounds brutal. Is it sustainable?
Well, that's the thing. This hyper-competition, or involution, as it's sometimes called there.
Involution.
Yeah, like intense internal competition that can become almost self-destructive. It has led to really aggressive price wars. The numbers show it clearly. January to May 2025, EV sales volume up almost 12%. Pretty good.
Okay.
But industry revenue, only up 7%.
Yeah.
And net profits actually dropped almost 12%.
So selling more cars, but making much less money on each one.
Exactly. Bleeding margins. It's a race to the bottom, and it's not sustainable for everyone.
Which is why the government is stepping in.
Precisely. Beijing regulators, MIIT, NDRC, SAMR, the big acronyms, they're clearly worried. They held high-level meetings in July, specifically to curb this irrational competition, as they call it.
What are they calling for?
Stronger price monitoring, basically telling companies to stop slashing prices so aggressively.
Right.
Better discipline in paying suppliers on time. And new standards for energy efficiency and battery recycling.
What's the goal there? Just stop the price war.
Partly, yes, stabilize the market, but likely also to weed out the weaker players. These measures tend to favor the bigger, more efficient, more technologically advanced companies.
Which are often the local champions.
Right, so it could end up consolidating the market around the strongest domestic players, potentially making it even harder for struggling foreign brands or smaller startups.
Okay, so that's the new rulebook China wrote. Speed, integration, software, new sales channels, intense competition. So why? Why can't the big global companies, VW, GM, Toyota, Honda, with all their money, all their engineers, just adapt? Why are they losing?
It sounds simple, right? Just play by the new rules.
Yeah.
But it's incredibly hard. There are these deep systemic issues, this massive inertia.
Inertia, like what?
Well, the biggest one is probably the inertia of the ICE profit pool. ICE meaning internal combustion engine.
The gasoline car business.
Exactly. For decades, that's where the reliable, high-margin profits came from. Billions and billions. So imagine you're on the board of one of these global giants. making the decision to aggressively cut prices on your new EVs, to invest truly massive sums in BEV platforms.
Knowing it will directly eat into the profits of your best-selling gasoline cars.
Precisely. Cannibalizing your cash cow. It's a really, really hard sell internally, especially when Chinese rivals, who maybe don't have that same profitable legacy business to protect, are ready and willing to fight purely on price and scale in the EV space.
So it's not just money, it's strategy and, like, internal politics.
Absolutely. It's deep organizational inertia. The whole company, engineering, manufacturing, sales, incentives, was built around optimizing combustion engines for a century. Shifting that muscle memory, retooling the entire global enterprise for an EV future that demands sacrificing current profits, that's an existential challenge. It makes them inherently slow.
Okay, the ICE legacy is one big anchor. What else?
The joint venture structure JVs in China is another huge drag for many foreign brands.
How so? They've operated like that for decades.
They have. But the market demands speed now. JVs often mean complex governance, shared control, sometimes conflicting priorities between the foreign and Chinese partners. Decision-making grinds to a halt.
So who decides on the software updates, for example?
Exactly. Software stacks might be split. Who controls the data? Are the incentives aligned for rapid iteration? Often the answer is no. Meanwhile, an independent Chinese brand like BYD or NIO can just decide and execute weekly pivots if needed. The JV simply can't match that agility.
They're stuck in committees while the market zooms past.
That's a good way to put it.
Okay. What else contributes to them losing share?
There's often a feature mismatch. The cars they bring to China are frequently underspec'd on those critical software features we talked about, the advanced ADS, the slick infotainment, the local apps.
Things Chinese buyers now expect as standard.
Right. Or, conversely, the cars might arrive overpriced once you factor in import costs for key components, currency exchange rates, maybe tariffs, like those U.S. import tariffs hitting VW's results recently. So the value proposition just doesn't stack up against local alternatives that offer more tech for less money.
And this makes them sitting ducks in a price war, right?
Totally vulnerable.
Yeah.
The local brands, with their localized costs and supply chains, can weaponize price. Foreign brands try to hold the line, protect their global margins.
And watch customers walk across the street to the cheaper, often flashier, domestic brand showroom.
That's exactly what happens. Showroom traffic just migrates. It's like that cruise ship analogy again, the huge legacy ship trying to navigate a fast, winding river full of agile speedboats. The speedboats have a massive advantage. It's structurally crippling in this kind of market.
Okay, it's a tough picture. So what can they possibly do? Is it too late? How do these global giants stop the bleeding and avoid just becoming irrelevant in the world's biggest car market?
It's incredibly challenging, but maybe not impossible. They have to make some radical changes, though. And fast.
Like what? What's the prescription?
First, and this is non-negotiable, localize the cost stack deeply.
Meaning?
Source everything possible. Batteries, motors, inverters, control units, and especially software locally in China. Or through really deep co-development partnerships with Chinese suppliers. Get rid of the import friction, the currency risk, build the car for China, in China, using competitive Chinese components and talent. That's the only way to get the cost base right.
Okay, localized costs. What else?
Second, drastically collapse decision cycles. Treat China as the lead market it is, not just somewhere you send cars designed in Germany or Detroit.
Give the local team power.
Exactly. Empower the China teams. Give them real authority over product planning, trims, features, software rollouts, pricing. Let them ship OTA updates at China speed, not waiting for global HQ approval that takes 6 months.
We are seeing some moves there, right? Like VW partnering with XPeng and Thundersoft.
Yes, those are exactly the kinds of moves needed. It's an admission that they need local expertise and agility, that they can't do it all themselves from Wolfsburg or Stuttgart. They need to embed that China speed into their own operations there.
Okay, third.
Partner where it matters most, especially on software. If your internal teams just aren't world-class at building a Chinese-centric in-car OS, or integrating local maps perfectly, or creating a voice assistant that truly understands the nuances of Mandarin.
Don't try to reinvent the wheel.
Right. Find the best local partners and integrate their solutions seamlessly. The car is a software platform in China. If the digital experience isn't top-notch, perfectly localized, and constantly updated, you've already lost. Hardware excellence isn't enough anymore.
Makes sense. Anything else?
Finally, they probably need to stop trying to be everything to everyone. The market is too fragmented, too competitive. They need to choose their battles, find a clear niche, a segment they can genuinely win and own. A beachhead.
Like focusing on premium hybrids. Or maybe super smart city EVs.
Could be. Maybe it's premium hybrids with the absolute best, most reliable ADAS for complex Chinese city driving. Or maybe it's purpose-built urban BEVs with unbeatable automated parking and navigation. Find that niche, dominate it, build credibility, and then maybe expand strategically from there.
So it's about flipping the script. Instead of just sending global cars to China.
You build China-specific solutions in China that are so good, so tailored, so innovative, they might eventually become exportable from China to the rest of the world. That's the mindset shift required.
That's a huge shift, which brings up another knowledge gap, thinking about that government intervention.
Right, the crackdown on price wars.
How will that actually play out for foreign brands? If Beijing forces prices to stabilize, does that help the foreign players who are struggling to compete on price? Or does it actually hurt them if they were planning to use aggressive pricing to try and claw back share?
It's a really interesting question, isn't it?
Yeah.
It could go either way. Maybe it gives them breathing room by stopping the race to the bottom. Or maybe it freezes the market shares where they are, benefiting the already dominant, cost-efficient local players.
Another thing to watch very closely.
So if we pull back and look at the really big picture here, what's happening in China's auto market isn't just a regional story. It's not contained.
No, it feels like a preview of coming attractions globally.
Exactly. It's a bellwether, a leading indicator for the entire global industry. The innovations happening there, the competitive dynamics, the consumer demands, that's likely what we'll see spreading to other markets sooner rather than later.
Okay, so looking ahead, say the rest of this year, Q3, Q4, 2025. What are the key things you're watching? What should listeners keep an eye on?
Good question. Several key indicators. First, that policy follow-through on pricing we just talked about.
How serious is Beijing?
Exactly. Do they really enforce these directives to stop the irrational price cuts? If they do, and the market stabilizes, watch who benefits. Does it prop up everyone, or does it allow the big, efficient players, mostly the Chinese champions, to consolidate their lead as weaker companies struggle? Regulatory action is a massive wildcard.
Okay, policy enforcement. What else?
Second, watch the tech entrant ramps very closely, the monthly delivery numbers, especially for the newer models.
Like Xiaomi and
Yeah.
NIO's new brand.
Exactly. Xiaomi, NIO's Onvo sub-brand, which is aimed at the mass market. These are crucial tests. Xiaomi, for instance, is forecasting 34,000 sales just in August. They're targeting 350,000 for the whole year.
Which is insane for a company so new. Can they even build them that fast?
That's the million-dollar question. They're facing huge capacity constraints. Wait times for that YU7 are reportedly up to 59 weeks, like 15 months.
Wow.
Their second factory is supposed to be fully operational by end of July, aiming for 8,000 cars a month. And they're already planning a third factory for another 450,000 units a year capacity.
They need that capacity.
Desperately. If they and others like Onvo hit their ramp targets, it signals that these tech-driven players are truly here to stay and reshape the volume market. It's a critical proof point.
Okay. What about the foreign brands? What should we look for from them?
Concrete action. Tangible announcements, not just vague promises. We need to see evidence of genuinely localized software stacks being deployed. News about restructured JVs that actually give local teams more power and speed. New deals for local battery sourcing.
Proof they're actually changing how they operate.
Yes. And the key metric to watch isn't just more EV models. It's faster cycle time. Are they speeding up development, iteration, updates? That's the fundamental capability they need to build or acquire in China. We need to see real operational change reflecting that China-first mindset.
Right. And the last big thing to watch.
The global expansion of the Chinese OEMs. This is maybe the most significant long-term ripple effect.
They're coming for global markets.
Aggressively.
Yeah.
Having survived and thrived in the hyper-competitive Chinese market, they are battle-hardened and increasingly confident. BYD launching 5 models for Europe at the IAA show.
Yeah.
Xiaomi already talking about entering Europe in 2027.
Yeah.
This isn't intended of anymore. China was the training ground, the pressure cooker. Now they're ready to take on the world.
So competition everywhere is about to get much tougher.
Much tougher. The established players in Europe, North America, other parts of Asia,
Yeah.
they need to be prepared for these new, highly competitive Chinese brands arriving with compelling products, advanced tech, and potentially very aggressive pricing.
So let's try and sum this all up. The bottom line. What does this all really mean for you listening and for the car world in general?
I think the bottom line is pretty profound, actually. China hasn't just become the world's biggest car market. It's become the most demanding, the most innovative, and the most brutally competitive.
The crucible.
Yeah. And the Chinese consumer. They're now the bellwether. What they demand today, that deep digital integration, the constant software updates, feature-rich cars, all at a sharp price point, that's very likely what consumers everywhere else will demand tomorrow.
So the trends start there now.
Increasingly, yes.
Yeah.
And it means the era of easy dominance for foreign brands in China is over, especially in NEVs. It's clearly waning,
So they have to adapt or...
or risk becoming marginalized. Not just in China, but potentially globally, too, as these Chinese competitors expand. They must adapt at China's speed. They must localize deeply cost product software, and they must embrace software-first thinking as a core part of their identity, not just an add-on.
It's not just a market shift then, it's more fundamental.
It's a fundamental recalibration. Like that chess game analogy, one side just introduced new pieces, new rules. Everyone else has to rethink their entire strategy, their basic assumptions about how the game is played.
It challenges everything.
Manufacturing, R&D cycles, supply chains, marketing, the very definition of what a car is, it's all being questioned.
Which leads to maybe a final thought for everyone listening. As this massive shift continues, as Chinese brands become serious global players, what assumptions might you need to challenge in your own work, in your own industry?
Yeah. What established truths about manufacturing or consumer behavior or global competition might be less true than you thought? How do you avoid getting caught flat-footed by the next wave of disruption, wherever it comes from?
Definitely something to chew on. So we've unpacked how China's NEV market has just completely rewritten the automotive rulebook, boosting local champions and posing this huge challenge to the foreign giants who once ruled.
It's a massive ongoing story, and this deep dive really is just a snapshot, a starting point.
Absolutely. We really encourage you to keep watching these trends, keep questioning the old assumptions, and think critically about what this global power shift means, because the ripples will spread far and wide.
It certainly will.
The story of how the car industry transforms is nowhere near finished, and you can bet we'll be here to dive deep into the next chapters as they unfold.
Looking forward to it.
Thanks so much for joining us on the deep dive. Until next time, stay curious and keep exploring.